Hi there and welcome to this video. My name is Andy Rowe and this is trendfollower.co.uk. This video is the third in a series of videos that I'm doing about how I'm attempting to create a long-term wealth building strategy, aka building my own hedge fund. But before I start this video, I need to tell you something very important, and that's that I'm not a financial advisor, and so I'm not qualified to give you financial advice. So this video is just about what I'm doing. It's about what I've done in the past, what I'm currently doing, and what I plan to do in the future. It's all about me. Obviously, if you choose to do some of what I do, you do it at completely your own risk. So I don't take any responsibility for your decisions. But it's important that we all have lots of information, and so I'm sharing my experiences and my thoughts with you in that spirit. So don't take it as anything more than my own thoughts. So what I plan to do today is talk about commodities. In the previous two videos I talked about my thoughts about buying shares and my thoughts about buying property. There's another asset class that's very important, and that's commodities. So that's stuff, and the capitalist world really relies on stuff being turned into products by manufacturers and sold and being consumed by consumers who are happy to pay good money for it. So stuff has to be manufactured from raw materials, and really that's what commodities are. Commodities are raw materials, so wood, iron, steel, coffee, wheat, stuff that essentially comes from the natural world around us. Some of it, we plant and harvest. Some of it is just there anyway. So commodities really is stuff, and of course at the end of the day, stuff will always have value because you can do something with it. You can make something with it and turn it into something useful. So I think it's quite an idea to invest in stuff, because of that. So it's possible to actually buy shares of stuff through an exchange traded commodity, and there's a company called ETF Securities who will buy and sell stuff, and or they produce essentially shares of commodities, and these are based on the future share prices of commodities in the future. So they're called commodity futures, and they have a value which can go both down and up. And so it's possible to buy, for instance, aluminium as an exchange traded commodity through a broker, just like a share. So whilst the markets are open, I could buy aluminium technically in my brokerage account, and I could sell it again the next day if I wanted to. And here's a graph of a share price of a commodity which has gone up and down, and essentially this is coffee actually, and you can see that a number of years ago coffee was at quite a high, and then it fell and fell and fell and fell massively, and then popped up again, went sideways, and then came back down again. So buying and selling something like this is not entirely straightforward, of course. So what I would hate to have done would be to have bought coffee up here and sold it down here, because I would have made a massive loss. So buying and selling something that goes up and down like this certainly isn't straightforward. So I would have to take quite a decision about buying and selling. So essentially I would act like a trader if I was buying and selling something like this, and this is something that we have to consider when we're dealing in commodities, is do we really want to be watching the market all the time? And of course not everybody wants to do that, particularly if we're thinking about making long-term investments. Many commodities in recent years have been in a long-term decline. You can see here, this is the price of natural gas, which for years now has been coming down and down and down and down and down, and it's one of those things that, you know, if I bought natural gas up here, you know, I'd be probably sick as anything to find the value of my natural gas shares being right down here. So commodities have really been in a pretty poor decline for many years, and this may be due to, you know, changes in consumer demand, things like fracking as well, where more gas is coming on stream, and so on. So it's very difficult to say what the future holds for natural gas, for instance. Is it going to go back up again in price? Well, it may do. I mean, a lot of natural gas can be used to power cars, and so on. LPG is coming more on stream for cars. It's a clean way of powering cars, but of course that is a complete unknown. So it's difficult to invest in something like this with a great degree of certainty that it's going to go back up in price again. And one of the problems with commodity ETFs is that they don't pay a dividend. You'll remember me talking about dividends being paid by companies to their shareholders in previous videos. One of the reasons that I like to own shares is that they pay a dividend, so that can create income which I can use to you know, buy food and live, or I can use to reinvest in more shares. But an exchange traded commodity does not pay a dividend. It's just, you know, the price of natural gas. That's it. So there's no income from it. So buying an exchange traded commodity, you know, has its downsides. Although it does, you know, it would give me a great exposure to the value, the price of natural gas, which is great if it's going up. But it's not paying a dividend along the way, which is a downside. Now, the FTSE 100 are the 100 largest UK companies, and quite a lot of these companies are companies that are related to commodity production. There are 7 metals and mining companies within the FTSE 100. There are 3 oil and gas companies in the FTSE 100, and there's 1 company that deals in forestry and paper. So one way of getting exposure to the commodity market would simply be to buy a tracking ETF of the FTSE 100, because quite a lot of the FTSE 100 essentially is a commodity exposure, and certainly in recent years the FTSE 100 hasn't really been hasn't done very well, and a lot of that's because commodities have been going down in price, and so because that makes up quite a large percentage of the FTSE 100, that has held back the FTSE 100's ability to go up in value, much to many investors' disappointment. What else could I do to get an exposure to commodities? Well, I could buy shares in the companies that produce commodities. So although I said, you know, I could buy the FTSE 100 ETF, if I wanted to have pure commodity exposure, I could go and buy companies or shares in companies that deal in commodities. So mining companies or agricultural companies, and that would give me a direct exposure to the underlying commodities themselves, or I could buy some exchange traded funds that hold those companies within them. So, for instance, the SPDR Metals and Mining ETF is like a share, but it's made up essentially of the share prices of metals and mining companies. So if I bought an ETF like that, then I wouldn't have direct exposure just to one company. I would have my risk spread amongst all the metals and mining companies within the exchange traded fund. I could do something similar with an agricultural ETF. There's quite a big one in the States called Market Vectors Agribusiness, and their ticker symbol is MOO. These companies quite like to have funny ticker symbols just to make them memorable, but if I bought MOO, then I would have exposure to agricultural companies that are held within the ETF, and that would spread my risk, and that's probably not a bad way to get exposure to commodities. Now, it's possible to buy an ETF that holds a variety of commodities, so isn't just a specialist one. I could buy the ETFS All Commodities ETF, AIGC. This is a UK ETF which includes 22 different types of commodities. But the downside to that is that it's a synthetic ETF. In other words, it doesn't actually hold the commodities within it, or companies that are concerned with that commodity production. Essentially, it tries to mimic how they would affect the value of the ETF's share price rising or falling by holding different types of financial securities, particularly government bonds. So one of the things that concerns me about buying that type of ETF is that it's fine when the financial world is all working reasonably well, but if some of the government bonds that are held as security within the ETF don't actually give the security that they say they will, then ultimately the trust could break down, and the ETF may not be worth what I'd like to think that it's worth. Now, there are investment trusts, and you've heard me talk about investment trusts before with regard to property and with regard to shares. In the world of commodity, there's also investment trusts, and these investment trusts will hold shares of commodity producers and bonds from those commodity producers. And one of them that I like to look at is an investment trust called City Natural Resources High Yield Trust. CYN is its ticker, and you can see its share price here on the graph. It's gone up, it's gone down, it's gone up, and it's gone down. And relatively speaking, it's at a relatively low ebb. And so some people might argue that there's a good point in buying something when it's gone down in price. You don't always want to be buying something when it's gone up high in price, because potentially it might fall again. Now, the City Natural Resources High Yield Trust does pay a dividend. So as of this month, May 2015, it pays a dividend of 3.8%. So if I were to buy it here, hoping it would go up again, it may do, then I would be earning a dividend of 3.8% whilst the share hopefully went on its upward journey. If it went up, of course, it might go down. And in some ways, particularly if I'm buying shares on a regular basis, there's some advantage to the commodity shares not being correlated with some of the other asset classes that I'm buying. So you can see on this graph here, this is a graph of the I think the yellow line is the graph of City Natural Resources. It's gone down, it's gone up, and it's gone down again. And the dark line is a graph of the FTSE 250 ETF called MID. So this is quite a good indicator of how UK companies have been doing. So back here you could see that CYN, City Natural Resources, and MID were nicely correlated. They went down together, they went up together, so the commodity prices were essentially moving in the same direction as share prices generally. Now, at this point, things started to change. The price of CYN shot through the roof. The price of MID, the 250 ETF, sort of kept on going in this direction, but up here the value of the CYN shares started to fall, and since then it's fallen and fallen and fallen, and essentially it's gone the opposite way to the way that the share price has gone. Now, that's bad news if you own lots of commodity shares, but when we're starting to think about buying shares in the FTSE 250 MID, and we're thinking, well, it's getting quite high now, is it going to fall? Do I want to be putting all my eggs in this basket, or do I want to have some of my eggs in this basket? Although the City Natural Resources High Yield Trust share price has fallen quite a lot, and that's bad news if I were to have bought up here, it's actually becoming increasingly good value the cheaper it gets. So there's something useful, and we'll address this a bit later on about investing in asset classes whose price movements don't correlate. So that could be quite helpful. It's worth having a look at the website trustnet.com to look at commodity and energy investment trusts. That there are a range of them, and for anyone that's interested in investing in commodities, it's worth looking at them. There's one here that I sort of have plucked out of the thin air, really. BlackRock Commodities Income Investment Trust. You know, you can see how the price has gone up and down and up and down again, and over the past 4 years its price has nearly fallen by half. So sick for those people that put all their money in here, but actually starting to look possibly like good value as we get down here. But who knows, it may halve again in price. That certainly is a possibility. Now, when I'm buying commodities, I want to keep my costs, my investment costs, as low as possible, and I don't want to pay too much in charges. And the brokerage that I use, who run my trading ISA, and remember, I like to keep things in an ISA because that means that the both the dividend and the capital gain that is made there is tax-free. If I'm buying a company that's in the FTSE 350 on a monthly basis, then they're only going to charge me £1.50 to make a purchase of that share. So to me, that's pretty good value, and I reckon that if I'm doing a monthly purchase, now I much prefer to do monthly investing so that I'm not putting all my money into the market at once. So I'm not going to be suddenly stung if the market falls off the cliff. So I want to put my money in monthly, and I want to keep the dealing charges to a minimum. I don't want to be paying £20 every month for one investment. You know, £1.50 sounds much more like the sort of number that I want to you know, to be charged. Now, there's a company called Vedanta Resources. It's a FTSE 350 company. It has multiple interests in different commodities, and it currently has a yield of 5.9%. So I think that's an interesting company for me to be investing in. Other possibilities would include food producing companies, and I'll leave you to have a look through the FTSE 350 and see what food producing companies there are there. So what I'm doing here is to try and build up a hedge fund. So this is a fund that's going to be invested across asset classes, so that if one thing goes up and one thing goes down, they're balancing each other out. Hopefully overall the things that do well will ultimately do better, you know, by a greater amount than the things that do badly will go down. I've started with shares. I talked about that 2 videos ago, and I mentioned about investment trusts then, international general investment trusts, or an ETF that does something similar. And in the last video I talked about property, and maybe the idea of using a diversified property investment trust or an ETF. And so what I've been talking about today is investing in commodities, and you know, using the idea of a commodity investment trust or a large commodities company that has a diverse range of interests. I've got a couple more videos I'm going to do that you might be interested in, because there are a couple of other asset classes that I'm going to talk about, because I think, you know, it's great to have fingers in different pies. But just remember, this is all about what I have done, about what I'm doing, and what I plan to do in the future. It's all about me. It's not investment advice to you. It's just my thoughts. No one knows what the future holds. No one knows what the best thing to do is. But I hope you found that interesting. So this was all about commodities, and I hope you enjoy it, and make sure you watch my next video and you'll find out what the next asset class is. So look forward to catching up with you then. Okay, bye for now.